FOMC monetary policy decision. The Fed cuts rate as US labor market weakens. Summary. As expected in its much anticipated FOMC meeting concluded on September 17, the US Federal Reserve slashed the Fed fund overnight by 25 bips point to 4.25%. Fed Chairman Powell does not see elevated financial risks. New dot plot. The Fed sees 2 more quarter point rate cuts by the end of the year and a quarter point in 2026, slightly more than they expected over the same period in June. Labor market weakening, which is major concern. Powell said this rate cut is a risk management cut. Market reaction. Initially, commodities and wider market rallied as Fed forecasted 3 rate cuts by end of the year. The US dollar index slumped to 96.22, a 43-month low as it made a fresh low for the year. Gold spiked to a fresh record high of $3,707 as the US yield fell. The US dollar index closed 0.33% higher at 96.95, while 2-year and 10-year yield gained 1% and 1.4% respectively. Silver tumbled to 1.8% to 41.7, while gold lost 0.56% to close at $3669. So what are the key takeaways? Fed will continue to monitor tariff-induced inflation risk, but it finds employment risk more heightened than inflation risk. The Fed sees 1 rate cut in 2026, but market sees Fed cutting rate by 40 basis points more than the Fed's estimates. Half a dozen officials saw long-run rate dipping below the so-called neutral rate of 3%. We'll monitor how labor market changing. Implications on commodities. Fed forecasting 2 more rate cuts by the year end is positive for commodities as investors have been expecting 2 to 3 rate cuts. Overall, the FOMC statement striking of solid labor market conditions highlights the committee's concerns over the US labor market. The Labour Chair acknowledging that inflation risks are down and employment risks are elevated also reflects the Fed's immediate priority. The US dollar index may gain slightly as the Fed Chair flagged tariff-induced inflation risk. This may pull commodities slightly lower, but downside is likely to be limited due to deterioration in the US job market and growing risk to the US economy. We continue to hold constructive view on precious metals, recommended buying the dips in very short-term dips in industrial commodities, if at all, are likely to be short-lived as dollar strengthen is seen fleeting. September forecast slightly higher growth and slightly lower unemployment rate is somewhat supportive for the industrial investors. Also expect Chinese stimulus as August retail sales, housing and industrial production data disappointed. Commodities may also get affected by monetary policy decisions of the Bank of England due today, Bank of Jammu due tomorrow. Both the central banks are expected to keep their key rates unchanged. Bank of Canada cuts its benchmark rate by 25 bps to 2.5%, its first reductions in rates since March, as its economy contracted at 1.6% annualized rate in Q2 amid tariff wars. Gold support is at $3,600 to $3,500 and silver is support at $41 to $40.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.